Are you expecting a flood of foreclosures, or are you expecting a housing bubble in 2023 or the coming months? Well, that's a great concern. And as an agent, I get a lot of calls and I read a lot of reports saying that consumers are expecting a big housing bubble, a lot of foreclosures coming in the market, but that may not happen. So let's analyze why they may not happen. It's understandable that a lot of the consumers, including myself, fear of a recession because what we went through in 2008, the foreclosure in the housing market, and a lot of my friends and agents and a lot of people I know lost their homes, lost their shirts, lost everything they had. So we do not want to repeat, definitely not want to repeat of 2008. And let's see what are the numbers that says that this will not repeat what happened in 2008. And I'm certainly hoping for myself and for everybody else that it's not going to happen. In the last 6 months, obviously the housing market has changed drastically. We all know that housing has peaked and the buyers just stopped buying. Add to that, the inflation was very high. In California, gas prices were $6.50. That is ridiculous and very high. On top of that, interest rates were as high as 7.5%. Back in January, they were around 3.5%. End of this year, it's almost 7%. And that's almost a 4% increase in interest rate. That has never happened in the history. So that knocked out a lot of the buyers. And also, just to let you know, if you bought a house, let's say for $500,000 at a 2.5% interest rate, and if you bought the same house today for $500,000, same house at 7%, your payments are almost gonna double. So a lot of the buyers have stopped buying. And you notice that because the number of homes on the market for sale have increased substantially. Used to be days on market, what we call how long it takes to sell, used to be 8 to 10 days. Now it's up to 45 days, up to 60 days. And the increase in inventory is as high as 40% nationwide. Of course, it depends on the areas, but everywhere the housing, the number of homes for sale compared to 6-7 months ago is up 20, 40, 50% from then, which means buyers are not buying as fast. More homes are on the market, and the sellers who want to sell and move to other markets are not moving. And also the sellers who want to buy are resisting in paying the 7.5% interest rate or 6.5 to 7% interest rates today. By the way, I'm Mike Patel from Orange County, California. Thanks for watching my channel. If you're coming here for the first time and if you would like to, please comment and share this video. And if I may also request, if you can subscribe and hit the bell button, I would really appreciate that. I have another video I did a few months ago. If you want to look at it, it was on housing market shift. I got a lot of views on it. And this was about 3-4 months ago, so you may want to compare that video to this video. I will put the link in the description below. So going back to the 2008 recession, one of the main reasons why we went into a recession was because there was relaxed lending laws. Anybody could get a loan. There was a saying back then as a joke that if you had a driver's license and if you made $20 an hour, you got a loan. Lenders were giving out what we call toxic loans, variable loans, 1% loan, all kinds of loans. So what happened was a lot of the people who could not afford to buy a house in the 2004, 2005, 2006 ended up buying the house. Not only that, a lot of the buyers or the sellers who own homes pulled out equity to the limit and used it for remodeling or vacation or medical or whatever. So the equity in those homes was pretty much zero. If you compare equity in 2022, as of August, on average, there was $300,000 worth of equity on every home. Of course, that's an average nationwide, which is a lot of equity compared to pretty much zero equity in the 2008. So because of those toxic loans, there was a big recession. But if you compare right now, there are all the loans that are given. I just got a loan myself last year, and the banks asked for everything to study and to scrutinize the banks and the tax statements. So for the last 5 years, because of what happened in 2008, all the banks that have given loans in the last 7, 8, 9 years have been very tough loans, very tight loans, and they made sure the buyers who bought those can afford to pay those homes. So even now, when you get a loan, they scrutinize you and make sure that you have A-class paper to get the loans. So the chances of you not paying on the loan or skimping on payments is very slim. So that's one of the reasons, and one of the main reasons that there is no recession coming as big as we expect is because the loans have been very tight. People have equity in the homes. So even if they lose a job or cannot make a payment for a year, and even if the prices drop, and then I sell my house, as an example, after a year without making payments, I can still sell and walk away with equity. let alone being short on the payments. So equity is a big thing. So one of the main reasons, well, actually the two main reasons there may not be foreclosures as much as you expect is one, because the loans were very good, so the buyers are not going to let go. And number two, the equity is there. There's a lot of equity in the homes. So by the time you deplete that equity, it may be a couple of years before we start seeing foreclosures. So let's see what happens. So I'm going to read a quote that says, not as many homeowners are in trouble this time. According to Marina Walsh, Vice President of Industry Analysis at the Mortgage Bankers Association, she quotes that for the second quarter in a row, the mortgage delinquency rate fell to its lowest level since Mortgage Bankers Association survey began in 1979, declining to 3.45%. Foreclosure starts and loans in the process of foreclosure are also dropped in the third quarter to levels further below their historical averages. Granted that foreclosures is up compared to 2 years ago. In fact, if you look at the chart, foreclosures up but near record lows. So if you look at this chart in 2022, quarter 3, from quarter 1 to quarter 3, there were 88,000 foreclosures. If you compare that to 2021, there were probably 40,000 foreclosures. But let's go back to 2006. There were approximately 700,000 foreclosures. In 2008, there were almost 1.5 million foreclosures. And 2009, there were 2 million foreclosures. If you compare that number, 2 million foreclosures or people behind the mortgages, to currently it's only 88,000 homes that are behind on payments or foreclosures coming up. So it's a negligible number compared to the 2008 number. And that's why people have this fear that foreclosures are coming. But if you look at this chart, we don't see it coming according to this chart. Going back to homeowners' equity, here is another quote on equity from the economist at First American. It says that homeowners have very high levels of tappable home equity today, providing a cushion to withstand potential price declines, but also preventing housing distress from turning into a foreclosure. The result will likely be more of a foreclosure trickle than a tsunami. If we dig deeper into that quote, here's another quote related to the above quote from Atom, and they explain that only about 214,000 homeowners were facing possible foreclosures in the second quarter of 2022, or just 0.4% of the 58.2 million outstanding mortgages in the US. Of those facing foreclosures, about 195,000 or 91% had at least some equity built up in their homes. So if you see the headlines and your friends talking about foreclosures or your peers talking about foreclosures, yes, it is true. Foreclosures have gone up almost 40,000 from last quarter in 2021, but it's way below the 2 million in 2008. So yes, foreclosures are increasing, but they are way below the pandemic levels, and it's going to take a while to get to the 1 million or 2 million or 3 million mark that can create a big housing crash. So thank you for watching.